one of the most glamorous things about fintechs you see is, and startups in Nigeria generally, this person has raised $100 million. This company has raised $200 million, and they are on newspaper covers and blog covers with T-shirts, looking very cool. And you're wondering, look at these small children with tens of millions of dollars, right? And now, that also presents some interesting, tax issues.
Hello and welcome to Tax Matters. I'm Chamaka Ohaochi. In time past, businesses had physical and permanent bases. That's probably where the phrase bricks and mortar came from. The taxman will put it differently: permanent establishment. For example, XYZ Nigeria Limited, 145 Eba Road, Lagos, and stuff like that. But in recent time, with the advent of technology, businesses have become less visible, much less identifiable in terms of their physical location. Fintech, standing for financial institutions making use of technology for service delivery, is one of the emerging subsectors of the tech industry. And make no mistake about it, the entire world is involved, and it has become more difficult for the taxman to keep track of the activities of fintech industry operators, as indeed many other sectors. On Thursday, the 19th of October, the FIRS collaborated with KPMG to hold a stakeholders engagement with operators in the fintech industry in Nigeria.
No doubt, the fintech business or the fintech industry in Nigeria is huge and is the largest in Africa. Based on some of the statistics, I'm here, it says that we are the most fintech populated country ahead of South Africa and Kenya. And that when you look at the last 1 year, the industry has grown by more than 50%. And that's a whopping amount of growth. And that in the last 2 years, the continent has actually attracted investment of like 2.7 billion. And 1 billion out of that, a bit more than 30%, have all come into Nigeria. And I think these are the headline numbers that FRS and everybody is seeing. And sometimes people think funds inflow translates to prosperity, translates to high tax revenues, and the understanding of investment, waiting period, and all that is not clear. So it's all about collaboration and opportunity to hear from FRS and for FRS to also hear from the industry itself and understand better the way fintechs do business and the antecedent tax issues. And some of them are simple and basic, but when you multiply the impact of those issues, then it becomes a big affair.
My presentation today is not just tax compliance of Nigerian fintech. It's about tax compliance of foreign partners of fintechs. We want the local fintech to encourage non-resident entity to comply with Nigerian tax law in line with global best practice. How? The first obligation of every fintech is that when they are signing any agreement with a foreign partner, they should incorporate tax consideration in their agreement. It's very, very crucial. The second obligation is that they should demand and encourage and assist with the registration of non-resident person, either it's corporate or individual. Why? Why should they register? Because they are not even physically present in Nigeria. They have to register because this is a digital world. You can be in America and be earning money from Nigeria without stepping to Nigeria. But the tax law says that any income that is sourced from a particular jurisdiction should be taxed in that jurisdiction to a very large extent. To register for non-residents is very, very easy. As you can see on the screen, once you type www.taxpromos.frs.gov.ng from anywhere in the world, you will see this landing page, and then you can click non-resident registration. Once you click it, within 48 hours, we generate tax identification number for you. Again, why should a non-resident register? Most of the payments you make, most of the income earned by non-residents through fintech, they are supposed to be subject to withholding tax at either 5% or 10%. Now, when you withhold 10% or 5% from that payment, how do you remit it if they are not registered? So the purpose of registration is for you to be able to withhold and then remit it, so that that withholding tax can be a tax credit for them in their jurisdiction. All transactions with non-residents attracts withholding tax and value-added tax. For value-added tax, you are expected to self-charge yourself and remit accordingly. For individuals, I know fintech sometimes they will employ freelancers. For that individual that is doing something for you outside Nigeria, either lawyer or whatever, tech guys, when you are signing the contract, include tax and charge him as an individual 5% withholding tax. Put it in your contract. If you have any foreign individual, you are supposed to also charge payee and remit to FRS. Now we know that non-resident entity invest in a lot of our fintech industry, fintech startups. At the maturity of their investment, when they want to go, they want to dispose their share. At the time of disposal, there is capital gains tax. And that capital gains tax is good for you to put it in your agreement that, okay, at the disposal of your investment, if it exceeds 100 million, it will be subject to capital gains tax.
Having taken the participants through their tax obligations, it was then the turn of the operators in the fintech industry to enlighten the FRS on their business model.
Sycamore is a peer-to-peer lending platform. We connect lenders to borrowers. So our platform, what happens is we have lenders that come on our platform and we have borrowers, right? So the lenders bring in funds, put it on the platform, borrowers take it out, and the borrowers, when they pay back with interest, right? And we split the interest with the lenders. So you have principal and interest flowing from, lender to borrower and then back. For most of us in the lending business, right, usually there's a hybrid model where as much as we have mobile apps, that does the risk assessment real-time online, we still have to partner with agents when we want to go and do micro loans, for example, places that they don't necessarily have apps. And in those cases, we partner with people with agent networks like, Paga and the likes, right? And in those cases, so for example, you give out a loan of 8 weeks and you have to pay, is amortized over 8 weeks. Now that, each of those repayments, which is paid weekly, would have a principal element, interest element, and in some instances, even a commission element that is for the agent. And there is a need to now separate what is payment, what is principal, what is interest, and what is commission for the agent, and how do we apply the appropriate transaction taxes on each of these elements.
I think there is a very important need for us to understand the difference between processed volume and revenue. What typically comes to the public is the processed revenue. And I'm happy to report that as well, because it enables me to attract more investors. The more transactions I process, the more investors' trust is in my business, that people trust your infrastructure, people trust your solutions, so I can give you more funds to do more things that you want to do. However, based on regulations here in Nigeria, there is a very, very small fraction of that I can charge as fees. In fact, in some instances, it's as low as 1% or less of whatever volume I've processed. So imagine that I processed a transaction worth $100. What that means essentially is that my revenue is just $1 out of it. But FRS comes knocking on my door. You guys, you look very well. You are wearing good suits. I can see this TPV of $100. Come and pay tax on $100. Come and pay company income tax on it. I cannot. It's not my money. The only amount I can pay tax on is $1. Now imagine that is my top line, not my net revenue. Now imagine that is not even my net my net profit, and it's not even my taxable profit. because after my accounting earnings, earnings before tax or after earnings before tax, you then make some adjustments to get to what actually my taxable profit is. So there is a lot that goes on behind that we need to get to a place of common understanding of, even though I'm seeing these huge volumes on these guys' rails, it doesn't really translate to revenue. And we've seen that play out a couple of times during audits when FRS comes to audit us. They look at my infrastructure, they look at my dashboard, they see that huge volume moving through, and they expect me to pay company income tax on it.
We deal with creatives a lot, and we deal with small-scale businesses, SMEs, which have not actually met that 25 million naira threshold. And then to have us withhold on the payment, that's charged withholding tax on payments to them. Like we all know, withholding tax is more or less like an advance payment to CIT. And if they are going to be exempt from paying CIT, they have an argument that why are we charging that withholding tax on their payment when in fact they're not going to use it within that accounting period.
Following the enlightening perspective from the fintech industry players, an interactive session followed, moderated by Nikki James of KPMG.
There's the issue of how do you separate income, principal, interest, and commission. So let me ask you, for the commission that you're paying to the agents, so how do you treat withholding tax?
We've had this long debate, who should actually be deducting withholding tax. In many instances, these agents are not, it's what you would term informal markets, right? So how realistic is it for them standing outside in a kiosk to actually withholding tax on their own commission that is supposed to be for them, right? And because I'm not outrightly paying, a lot of times I don't have the opportunity to even withhold because they've already taken it at that point. But we've had these debates a lot of times. Fine, there's what is obligated by law, but there's also the practical reality of what's happening in the market. So a lot of times I don't even get the opportunity to, or we as Sycamore don't even get the opportunity to actually withhold because we don't even get the payment in the first place.
What changes will you like to see FRS undertake to solve some of these tax issues that as fintechs you are facing?
Okay, I think the very first change would be for us to, again, like I said earlier, get to a place of common understanding, of what constitutes revenue for a fintech company and what doesn't constitute revenue. We need some form of help from tax administrators to help us push to lawmakers. If we can have some special tax holiday for fintech companies, startups, maybe, I know it's a fast stretch, maybe like 10, 15 years tax holiday for us to settle. Because again, it's a lot of work going into it. Just for us to be able to, because it's a volumes business. The more volume I'm able to process, the more money I make, then the more tax I'm able to pay.
And we can't overflog this. Volume doesn't mean we're making that much money, right? It's just what we're processing, right? And if we're being taxed based off of the volume, that means then I have to start paying out of pocket, which is not a good, like you said, it would take more or less 20 years to even break even, not to talk of making profit. FIRS can actually assist by looking into the tax imposed on fintech companies, looking at the intricacies regarding revenue recognition and what is taxable, right? And then we'll be able to see how then we can grow and then impact more lives.
More participants were also given the opportunity to ask questions and make recommendations. And these responses from the FRS.
We've heard the issues and the pains of the fintech industry. And I think there is one key takeaway from that last session, and it's just about understanding the business model. There's one thing we always talk about in KPMG, that if you're working on a client, the first thing is that you must understand the industry code. You need to understand that transaction flow, the revenue flow. If you don't understand that, then it's going to be very difficult, for you to be able to conduct your review. And that is what has come out from that last session. So, and I think it's something that FRS, they do that very well. I remember with Shegun, when you started the telecoms, the first thing that you did was to have a capacity development, for the members of that technology department, just to have a better understanding of how, the sector works. And it's the same thing with fintech. That is what has come out clearly, really. So, and I think the first thing is, what do we do to bridge that knowledge gap, right? I mean, how do we get to understand, the various business models that all these fintech companies are involved in?
Yes, I think this is why we are here. We're trying to understand the business model of all the players in the industry. So again, if we go back to the fundamentals, and this is for FIRS staff actually that are here. If we go back to the fundamentals, if you go to a bank, are you looking at my customer's deposit as what to charge as income? As to charge as when you are charging CIT or whatever? Is it the customer's deposit you are using? Certainly not. So it's the same thing. Banks have commission. When you look at their financial statements, there is a line for commission. There is a line for interest. There is a line for, other fees, and so on and so forth. So we have to just go back to the fundamentals. The same thing with fintechs. The fact that you're a gateway, you are not a bank. You're actually not licensed to be a bank. And some of you had your licenses revoked because you were doing the wrong thing. So if we come to you as FIRS, we have to come with an open mind. And I remember I've been telling my team about that. We need to go with an open mind as FIRS, and you need to also have an open mind that we're not there to actually try to catch you. So this is a very good interaction. Regarding the issue of EMTL, yes, we have engaged with a number of you, and those that were able to explain to us the nature of their business. I recall we requested that you should remove those institutions from the EMTL levy, because they are not banks in that sense. They are just a gateway. They don't keep money. They don't have the license. They are not supposed to. The risk is too much to the system, and so on and so forth, yeah? But of course, some things are lost along the way, and then, so I'm very happy that the FIRS team that is in charge of EMTL is here, Tax Pro is here, and everybody is now beginning to understand that we need to look at each fintech's business license. And we have even engaged CBN too. We need to look at your license and make sure that it is based on your license that we are making you to comply with the rules that apply to you. Now, regarding agents, it's difficult for you to say you want to be sure that the agent, whether it's 25 million or less, and so on and so forth, and whether you should charge. You see, the withholding approach is so that government gets some revenue from certain individuals. Now, let's look at it. If the agent is even an individual, some are agents as individuals, yeah? So the withholding you are doing is actually on their income as persons, on their personal income tax, not under CIT. And then you have those that are under CIT. But the idea is you have to charge that withholding where it's feasible. In some cases it isn't, simply because the model you have designed is that they pay they are paid the commission by the person doing the transaction. So I'm withdrawing 10,000 naira. They just put their 200 naira. You don't have anything to do with that. So you don't even have the chance to withhold. So that's a different model that needs to be understood. But where the money passes through you, for you to settle them, then you have to charge that withholding because the money passed through you.
The legislation is clear as to what constitutes revenue, but we can't overemphasize it. Revenue recognition, like you said, is one of the areas we explored when we started the telecommunications business, and it's very clear. And the fact that you have operating expenses, capital expenditure, and stuff like that makes it where it's not, you need to run the whole gamut before you can start saying that you break even. So we understand that. We understand the provisions regarding the Finance Act when the Finance Act was introduced, there are even provisions in the Finance Act that talks about definition of some terms. This issue about gross profit, gross turnover and stuff like that, they are all discussed. So we understand what constitutes your revenue. And I'm not sure that any revenue officer would say he wants to put minimum tax on what is not your own, your income.
But the whole definition of a company income tax is on profit. When you don't have a profit, nobody will be taxing you. If you have a loss or you don't have a profit, there is no tax on it. So there's no tax officer, I don't think, that will tax you on your volume. I don't think. Except maybe if you didn't provide enough information, then the same law, Section 30, may apply. Even at that Section 30, there is an assumed 80% given to you as a cost. So even that one issue of saying that on volume have moved. So the tax operations or your records is you that know this very well, and it's you that's supposed to educate us. FRS have invested a lot in understanding what a taxpayer's business in. I've experience in investigation and audit. I know before we go for audit, we will call a taxpayer. The first meeting is just to understand the business of the taxpayer. When you reach on field, the first meeting you have, you still find, we insist, the responsible officers to come and educate us. How do you do? What is your line of income? What is your line of expenses?
Okay, I think there is one question that we've not addressed, and I think it borders on withholding taxes. They do understand the fact that the law mandates them to withhold, but they've also spoken about situations where they are unable to withhold, right? I think that is one area of assurance they need. So I don't know, are we in a position to give them assurance as to what will happen in that situation, especially when it comes to an audit?
It's difficult for you to sit in your organization and determine that this taxpayer is below the threshold. So what the FRS has done, and I think it's also included, contained in our guideline, is that, yes, if they do business with you, because your own single transaction may not constitute 25 million turnover, so you can withhold. These companies file returns, and when they file their returns, there are avenues for them to show that certain amount has been withheld from them. And in our refund arrangement, we've made it clear that it's not every refund that will go for this audit. So and we've set out funds to make sure that as soon as we get those kind of requests, their money is paid back. Yes, it will eat into their cash flow. There's a timing issue, but until we are able to see through this whole process, that is what we have in the guideline for now.
Here there are two taxpayers. Let's understand it. You yourself as FinTech Nigeria, number one, and then the third party from the offshore. What is he giving you? What are the relationship do you have? If it's just investing money and you are paying him dividend, then withholding tax will apply. You have that responsibility to take that withholding tax. And if those people are rendering management, consultancy, professional and technical services, that's the amendment of section 13(2)(f), will give you another responsibility. They should take withholding tax on the transaction. So you even have to self-charge VAT on those transactions. Understand there are two taxpayers here. Since the other offshore is not in Nigeria, that responsibility have gone back to you based on our amendment of the laws.
The session was an eye-opener for us, as we do believe it has been for you. There is no doubt that the fintech industry and the entire technology eco-business system is becoming huge, and that the taxman, the revenue collector, has a lot of gold hidden underneath the ground. We do hope that this stakeholder engagement and the many more that we are sure that are on the way will bring both sides to better understanding of what they do and how they do it. We round off with this food for thought, and it is with regards to the song and dance over the exclusion of companies with turnover below 25 million naira from companies' income tax and from charging and collecting VAT on behalf of government. Hey, if a company operates Monday to Saturday throughout the year, that will be 312 days thereabout. Use that to divide 25 million naira and you will get a little under 81,000 naira per day. Turnover, not profit. 81,000 naira is not that much. It's not a huge sum. Just food for thought. Just thinking aloud. Let's meet again next week. Same station, same day of the week, same time of the day. Thank you for watching.